All right, so we're going to continue with the events here. We've gone through 5. Let's go to the shipping term, number 6, shipping term on the inventory purchased in event 2. All right, so in event 2, when we went and bought a count on merchandise, we bought it in terms of FOB shipping point. FOB shipping point and FOB destination. Basically, FOB shipping point means you got to pick it up at the store, which means that you're going to have to pay to get it to your house, as opposed to FOB destination. Now, when you buy crap from Amazon and you get the free shipping, that is FOB destination. Amazon pays to get it to your house. If you go over to Walmart and you buy something at the store, you're buying it FOB shipping point. That means that you got to get it from Walmart to your house. All right, so there's a lot of other types of shipping terms in there. Back when I was in school, back when it was hard, we had to know 6 or 8 of these things. Basically, all this is you want to keep track of who has to pay for the shipping. And if you try and memorize the terms, try and think of FOB shipping point. That means buying it at the store and you got to get it paid to get it to your house. FOB destination means they're going to deliver it to your house. If they're delivering it to your house, they pay the shipping. If you got to pick it up from the store, you pay for the shipping. Okay, so in this instance, the company paid $300 out of the checking account, and $300 out of the checking account is $300 added to the cost of the inventory. Because the cost of the inventory, what does it take to pay? What do you have to pay to get it sitting on the shelf? All right, so if we're paying freight, that's just part of paying to get that stuff up on the shelf. Okay, and another important thing to note is so far we've gone through 6 of these activities here. We still haven't sold anything to anybody, okay? We're still getting stuff on the shelf to get ready for sales. So it doesn't appear on the income statement until we actually start trying to sell it to other people. All right, let's go to 7A. Speak of the devil, JPS recognized $24,750 of revenue on the cash sale of merchandise that cost $11,500. Okay, so the checking account went up by $24,750. Yahoo! Because we had revenue of $24,750, which goes to our retained earnings. So we finally sold some stuff, $24,750. Of course, it's not all gravy. Here we go to 7B. We also have to recognize that we sold $11,500 worth of our inventory. Okay, so that's an expense, the cost of goods sold. And that comes out of retained earnings. All right, so we earned $24,750, but it cost us $11,500, so that has to come off of the total. It comes out of retained earnings, and since it's a net income item, our net income from that sale is $24,750 minus $11,500. Roughly $13,250, doing that in my head. That's the increase in the retained earnings. Okay. So that's 7A and 7B. Number 8 is JPS paid $450 for freight cost on inventory delivered to customers. So we sold this stuff to our customers as FOB destination. That means that we also had to pay $450 to get it to our customers. The $450 comes out of retained earnings because it's an expense. All right, so I didn't earn as much money as I would have liked. All right, let's go on to event number 9. JPS paid $5,000 cash for selling general and admin expenses. All right, so my cash goes down by $5,000. It's got a balance. That's an expense, so that's earnings I'm not going to retain as I record another expense over here. Okay, so you might notice that these income statement items are all 24,750 of revenue minus these expenses is all coming out of retained earnings. Okay, so retained earnings is basically the net income. We're recording each individual item, but of course, if you're looking at the financial statements, all you're going to see is the grand total. But we do want you to know that the grand total came from somewhere. They ain't just making these numbers up. Well, that's our story. We're sticking to it. All right, number 10, JPS paid $360 cash for interest expense. I noticed I misspelled interest. Should run the spell check. All right, number 10, I paid $360 cash for interest expense. Negative $360, and the interest expense is on the notes payable that I borrowed back in the day. Now, notes payable generally is an interest-bearing account, and that's just another expense of doing business. So it comes off of my retained earnings. The balance sheet still balances. By the way, $360 on a note payable of $4,000, that's a lot of interest. That's one of the things that we would want to pay attention to. That's about 9%. Now, we haven't told any dates in here. If this was over the course of the year, 9% on a note payable would probably be okay. But remember, there's going to be thousands, tens of thousands, millions of transactions in here. And we do want to keep track of stuff like that because how much interest you pay on the borrowed money is an important aspect of whether it makes sense to borrow that money or find another way around it. All right, so going to number 11, JPS took a physical count of their inventory. Now, notice that we started the year with 6,000, bought 11,000, returned 1,000 of it. We took basically a discount of $200 on this net $10,000 cost. The $300 here from item 6, where we ended up with the charge for the shipping it, and we sold 11,500. We're carrying $4,600 as the value of that inventory. And somebody went in there and counted stuff up, and you know what? There ain't $4,600 worth of stuff on the shelf anymore. Some of it's wandered off. Okay, so how to address this? Well, it's actually much more complicated in the real world, but accountants have to keep the complicated stuff. You and I are just going to recognize that there's $500 worth of stuff missing. We call that shrinkage. Okay, well, it's a non-cash charge. We just say, okay, well, inventory went down by $500. And we're just going to chalk that up to an expense of doing business. It's sort of like maybe we sold it or lost it or whatever. We sold it for $0 to a light-fingered employee or rats or what have you. And to keep our balance sheet balancing, we'll just take it off of retained earnings. All right, now out there in the real world, there's a lot of other ways of doing this. But usually the shrinkage is so small that the easiest way, most people just treat it like you sold it to somebody for $0 and your cost of goods sold was $500. That's the easiest way to do it. Now, if you went in there and you're supposed to have $4,600 of inventory and there's $3 worth of inventory, now maybe we need to take a deeper dive into it. But in this case, yeah, it's $500. What the heck? All right, so go to item number 12. JPS sold land that cost $5,500. Okay, so remember this land that we bought for $5,500 back at the end of year one? Now we have sold it to somebody for $6,200 of cash. So cash goes up by $6,200. All right. Unfortunately, though, we only had $5,500 of land to take out. All right, so now my balance sheet isn't going to balance because my total assets, this goes up by 6,200, this goes down by 5,500. I got to do something over here. Well, the difference between the 6,200 and the 5,500 is going to be a revenue item. All right, now it's not from selling stuff, but this is non-operating revenue. So where it's going to show up is somewhere over in the income statement. And so we'll just record $700. It's not exactly revenue from what I do for a living, but it's non-operating revenue. And that means it's going to go over here into the retained earnings. And lo and behold, now my balance sheet balances once again. And that's the good news. Okay, so in the first half of the video, we walked you through basically the first 6 steps, and then the first 5 steps, and then the second part of the video, we walked you through the rest of them. In the third part of the video, what we'll do is walk us through the cash flow statement. Well, let me remind you where we're at now. We started the year with $6,500 in cash. Through the course of the year, buying and selling stuff, we have added and subtracted to the cash, and now we have $25,540. That's good news. We have $4,100 of inventory. We thought it'd be $4,600, but lo and behold, we shrunk some of it. We started with $5,500 in land. Now we don't have all that land. We have less land. We have 0 land, and we have total assets are $29,640. The liabilities and equity, we started the year with shareholders' equity of $18,000, and now we have $25,640 of equity. That's good, it's going up, but we also have some accounts payable. My sum total wasn't working. We had some accounts payable where we borrowed money to get this, but we paid it off. We still have this note payable, which we haven't paid off. So I still have $4,000 of other people's money. The sum of my liabilities and equity has to balance with my balance sheet. All right, my net income for the year between the $25,450 in revenue of one form or another minus $17,810 in expenses, I ended up with $7,640 of net income, which added to the $3,000 I started with retained earnings up to $10,640. All right, so in the third part of this, what we'll do is go look at what happens to the cash flow.